Stocks swing between gains and losses as investors fret over the inflation and interest rate trajectory. IT and capital goods gains while energy and healthcare sulk.
Samvardhana Motherson is the stock on our radar as it struck a deal to buy SAS Auto System Technique, a global cockpit module and EV solutions vendor, for €540 million in enterprise value. Analysts have given the EPS accretive move a thumbs up.
And the Cipla stock slips after the US FDA issues a Form 483 with 8 observations for its Pithampur unit, which contributes over a sixth of its sales. The street worries over the nature of undisclosed observations.
The government asked Hindustan Zinc to not proceed with its proposed acquisition of Vedanta arm Hindustan Zinc. The company tells CNBC-TV18 it will engage with all minority shareholders and is looking to grow globally via acquisitions.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Manglam Malu as well as Sonia Shenoy. Well, it's turning out to be a quiet start to this week. So let's see how things progress because we do have the Fed minutes later on in the week. Not to mention that IT continues to gain today. We have financials which continue to underperform from last week. Just to put it into perspective, a couple of statistics. Year to date, the Nifty Bank is down around 4.5%. The PSU Bank index has lost over 12%. Nifty IT is up around 9%. So that's the kind of underperformance from the financials and the outperformance from the entire IT space. A lot of stocks in focus, Tech M, Cipla to name a few, and obviously the Adani stocks and Samvardhan Motherson Sumi, which Sonia will probably discuss further in this show.
Absolutely. And you know, the thing is, I guess the market knows for now that this 18,000 level on the Nifty is a bit of a hurdle, right, on the upside. And the hawkish Fed speak is something that's just putting a lid on the gains across the board. There are no cues later in the afternoon, later in the evening from the US either. The US market is shut for President's Day. So in that context, not too much to ponder over for our own markets. Right now, just gravitating between, the 20 DMA of 17,855 on the downside and the 18,000 level on the upside. So really very range bound. Let's see, it's been 3 straight weeks of losses for the US markets as well. So let's see how the rest of the week goes. It's F&O expiry too, so that assumes importance.
It is F&O expiry week and that is something that we will watch out for. But you know, the good part is that while we are in a range, the range has moved higher. Sometime last week we were talking about the range of 17,650 at the lower end to 17,800 at the higher end. Now that has been broken. We're looking at 17,850 at the lower end and almost 18,050 at the higher end. The good part is that the mid-cap index is outperforming today. We do have that index up around 0.25%. And if you just take a look at a bunch of stocks, they're doing much better than what the frontline index will have you believe. And I'm looking at specifically all these new age businesses. So we have Nykaa, which is up 5%. Delivery is up around 4%. Zomato doing extremely well as well. And as we speak, all cargo logistics, which was weak in all of last week because of the numbers, is now bouncing back from the lows, up around 6% as we speak too.
Okay, so a lot of stocks buzzing around, and let's start off the show with one particular company from the pharmaceutical space. It was in fact a steady quarter for RPG Life Sciences as the company reported a 13% revenue growth with margins also improving despite ongoing geopolitical challenges impacting the supply chain. The domestic formulation in fact is the biggest contributor to sales with around 55% of sales coming in from the Indian market. To discuss more on their Q3 performance, we have Mr. Yugal Sikri, who is the Managing Director at RPG Life Sciences now joining in. Mr. Sikri, hi, thank you very much for taking the time out. Well, I just wanted to touch upon the domestic business because that is around 55% of your sales. Can you tell us how exactly did you all perform in this quarter? What was the breakup in terms of volume, value growth, and the growth from new brands as well as your legacy brands? And what are you envisaging in terms of India growth for the company?
Thank you so much for taking me on the call on your channel. Yes, you talked about the Q3 performance, which has been pretty good. On the domestic formulation side, where your specific question was, we continue to grow faster than the market. This is the trend which you're maintaining for the last 4 years. And we expect that growth to continue. And that's our prognosis for the domestic formulation business. In terms of the growth drivers, which you talk about, price, volume, and new products, The price growth has been to the tune of around 4.5-5%. Volume growth is the one which is significantly high, which is healthy, high-level single-digit growth, and the new products continue to grow at 2.5 to 3%, contribute 2.5 to 3% toward the growth. So all the key drivers of the growth have been performing well.
Okay, so in terms of volume growth, I think on an average you've done about 12-13%. Is this something that you can sustain in the last quarter of the fiscal and also in FY24?
Yeah, our going by the trajectory we have had so far, so I can say that we'll continue to grow double digit. We will continue to grow faster than the market, and more importantly, on margins as well, our growth trajectory continues. We have every year we have been recording higher margins than the earlier, and today I'm happy to share with you that we have achieved benchmark margins in the competitor companies.
You know, you've preempted my next question, Mr. Sikri, and we've been having this conversation over the last many quarters where your margins have consistently improved. FY19, they were 10%. Then, now as we speak, they're 22%. The question is if this is sustainable and if it is likely to grow further from here, what's your target? And secondly, you've been talking about new products as well. The contribution of that, the last time, was close to around 19 to 20% of your overall sales. Where do you see that number going, given that you've launched about 8 extensions in the first half of this year?
Yeah, specifically first on your question on margins, as I've been explaining every time, our margin expansion trajectory is more structural. And what do we mean by structural? That is driven by the headcount optimization or span of control optimization. We have done some formulation re-engineering where we have challenged the formulation of the existing products, efficiencies enhancement. We've also prevented P&L leakages from the system and efficiency. And I think all 4 factors are structural. So I expect that margins should continue to be at that level. Going forward, whether the margins will improve, it largely depends upon how the situation on the input cost pans out, APIs, solvents, packaging material, all of that put together. So that's what I feel with respect to the margin. Coming to the new products, yes, the new products, we are focusing on on both the segments, mass business as a specialty business. Our drive on new product launches continues. We have launched monoclonal antibodies, 5 now. Last quarter, we have launched yet another product called denosumab in 3 therapies, which has a good traction. We have a life cycle management strategy continues in terms of new line extension launches. We launched Neprosin Plus, which is taking our product close to about 50 crore plus this year. And that strategy continued along with our customer segment expansion.
Okay. Mr. Sikri, I'm sure you've noticed that in the domestic market, one of the strategies which has been deployed by a lot of the pharmaceutical companies is M&A. Either you're buying a portfolio of drugs, either you're buying out the entire domestic business of a company to grow the domestic market. You have in the past indicated, and I think it's one of the priorities as well, that maybe acquisition could be something that y'all would look at. Are y'all looking at acquisitions in the domestic market actively? What might the cash on books be? And is that something that we could probably expect in terms of growth?
Yes, I think you rightly remember. The inorganic has been one of our consideration in our active consideration. And to be very frank, I think we have been actively looking at acquisition, whether it's a brand acquisition or company acquisition, but we don't want to compromise on profitable growth, the trajectory which we have set. So, and we also created a very specific agenda in terms of product portfolio, in terms of gross margin, in terms of the therapy gap which exists. So all of that considerations are driving our M&A thought. We have been evaluating actively, and let's see when the right candidate comes and we move on with the inorganic route as well.
Okay. Mr. Sikri, just a quick last question, and the reason I'm bringing this up is because of the kind of stock reaction we are seeing on Cipla today. The US FDA has issued 8 observations to one of their facilities. We don't know what the nature of the observations are. What is the status of the warning letter that you all were issued by the US drug regulator all the way back in 2013? The US, are you looking at it actively as a market, or are you going to probably just be a distributor or marketer of drugs there?
I think your question brings to me another point which I thought I must highlight. International business is also our second priority after the domestic formulation business, and we have. You talked about the U.S. warning letter. I'm happy to share with you that both our plant, formulation plant as well as API plant, the U.S. issue was with respect to the API plant as well as the formulation plant. Formulation plant, we have cleared everything. In the API plant, we are addressing the specific issue of the plant upgradation to match the standards. We are investing heavily on capex. That exercise is going on. Similarly, we have spent heavy capex on the formulation plant, which will gear us for the international business. The US, frankly, would be our last priority. We are maximizing on the Europe, Australia, Canada, and the Asia markets. And that's where our growth is being expected. We're also working on the new product development. We have a stream of new products which currently our R&D is working on. When the two plants get ready, then we have the new product pipeline also supporting the international business.
Okay, so we'll leave it at that. Just one final question. You said you're actively focused on inorganic growth. So you do have cash on your books. Can any of that be deployed for acquisitions in this calendar year itself? Have you shortlisted anything?
Yeah, I think it all depends on the opportunity. And yes, the cash generation is to support our future growth. Some of the cash is being deployed for plant upgradation. And also we have the cash for the inorganic opportunity.
All right, we'll leave it at that. Thanks a lot for joining in and all the best. Well, that's RPG Life Sciences saying that they've achieved their benchmark margins, their volumes will continue to be in double digits, and they're actively looking for some kind of inorganic growth as well. Let's slip into a short break. Lots of stocks in focus, Samvardhan, Motherson, Cipla, reacting to all the news flow. We'll get you an update on all of that in a bit. Welcome back to Halftime Report. It's that time on the show where we tell you about all the buzzing stocks of the day. Now, Samvardhan Motherson is a stock in focus. The company has made a big acquisition. They've picked up 100% stake in a German-based company called SAS Auto System Technik. This is for an enterprise value of 4,800 crores. Now, this company, SAS, is a provider of cockpit module assemblies for the auto industry. And they have a large exposure to the premium vehicle space, especially in electric vehicles. So this is a space where Samvardhan Motherson wants to grow in a big way. Now, the acquisition is EPS accretive and it's a fairly large acquisition. So the revenue of SAS is a little under 8,000 crores, which is about 10% of SAMIL or Samvardhan Motherson's FY23 revenues. And it's also a high margin business that they've acquired. About 11.5% is the EBITDA margins, which means SAMIL is currently operating in the range of 6 to 8% margins. It means that the blended margins now post the acquisition will go up. So it's margin accretive as well. The acquisition will be funded through internal accruals and debt. So that is, a bit of a worry. But the management did tell us a while back that at the max, the debt equity will go to about 2 times. So they're not too worried about that. This company, SAS, has a large exposure, as I said, in the electric vehicle space. 60% of their revenues comes from Europe, 31% from America, and 9% from China. They largely make cockpits, consoles, door panels, so everything that you get in a car. 90% of their revenues comes from consoles and door panels. And Elara Capital put out a note where they said that the acquisition is positive. It will help the company increase their content per vehicle. It will help them increase their EV exposure as well. Will add about 12.5% to existing FY24 EBITDA. They have a buy with a target price of 95 on the stock. However, the management, we had quizzed them on whether this means more debt on the books. Listen in to what they had to say.
The debt EBITDA, net debt to EBITDA ratio is what we follow, which is 1.8x basis December results that we announced. Even if we consider the whole 540 million as debt, just theoretically, we would be slightly above 2x. And considering an improving trajectory going forward, at the point of closing, I still expect that the whole thing will still mean a debt EBITDA of less than 2x. When this asset comes in on a blended basis, the margin profile should look better than what the SAMIL one is right now. This asset carries 50% of its revenues being EVs. So in effect, we would be looking at closer to 8-9% at an aggregate level now. Having said so, our own portfolio, if you look at from an order book perspective, nearly 37% of our order book is also EVs. So going forward, the share of EVs seems to be increasing quite substantially at an aggregate level for us as well.
Okay, so that's one buzzing stock, but the other one which is in focus on account of news is Cipla, which is one of the top losers on the Nifty today, and that is on the back of news that the US drug regulator has issued 8 observations to their Indore or Pithampur facility. It was inspected from the 6th of Feb till the 17th of Feb. Now, remember that this particular facility contributes to around 25% of their EBITDA in FY23. It is an important facility. They do manufacture respiratory products, oral products from this particular plant. Hence, it is quite important after Goa as well as one of their Invigen facilities in the US. Now, the street is worried about the nature of these observations. We know the quantum of the observations, which is 8, and then the assumption is that maybe it might not be easy for them to resolve these 8 observations, and the nature of the observations might be adverse enough for Cipla to not resolve them in time for the launch of key products such as Advair generic, which is an inhalation drug, which is filed from this particular facility. Now, the street was anticipating that Advair generic could probably be launched by Q1 of FY24. This will probably get pushed into FY25. Now, another example is the Goa facility, which in fact had a warning letter. They have a Brixon generic, which is a cancer drug, which is filed from that particular plant, and hence it's going to get pushed forward or delayed because of the inability to solve the outstanding issues. So that the street is assuming probably a worst case scenario for Cipla as well. Incred has written on it. They say that both the products, which is Advair generic as well as the Brixon, are likely to see worse competition going into FY25. They've cut the target price on Cipla. The likes of Macquarie have an outperformed target price 12.35. JP Morgan overweight with a target price of 12.10. According to them, Advair could contribute anywhere between 5 to 6% in FY24 and 25. So that's on Cipla. Stock down around 6% below 1,000 rupees. Time for a break now, but Ruchir Jain will join in next to discuss what he's strategizing this Monday. Stay tuned.
Well, the mid-cap index is outperforming now. Started the show with a 0.25% gain, now up almost 0.5% for that index. And doing well are some of these cement stocks, not only from the frontline end of things. We have Ultratech Cement as well as Shree Cement, which is among the top gainers on the Nifty. Even the broader markets, JK Cement has perked up at the high point of trade for that counter. Ramco Cements, a couple of these south-based names like India Cements, and even from the Adani Group, we have ACC, which has moved to the high point of trade. This morning, we had an analyst coming in from Nuvama saying that there has been a price hike in the cement industry, and the fact that the EBITDA per ton increase in the third quarter could actually continue into the fourth quarter as well. So that's as far as the markets are concerned, but also just keep an eye out on the F&O space, and that's primarily because this is the start of the expiry week. In the indices this afternoon, in fact, all the way since the last couple of trading sessions itself, we've seen some weakness come by in the Nifty Bank. So while the Nifty is down just about 20 odd points, the Nifty Bank is down 0.5%, and that's the one which is underperforming. But because this is the expiry week, we have both bulls as well as bears looking at levels on the way up. Levels upwards of 18,050 or thereabouts is where the resistance is come in. Why do I say that? Because the 18,000 call writers are extremely active. The Nifty fell from a high of 18,035 on Friday as well. So 25 lakh shares written at the 18,000 call for a premium of 60 rupees, telling you 18,050 to 18,060 is a bit of a resistance. However, bears have some hope, bulls have some hope by writing the 17,900 put. You have 70 rupees on offer for premium out there. That's telling you 17,830 thereabouts could be an important support. And technically as well, that ties in with the 20-day moving average, which is 17,848. So 17,830 to 850 on the Nifty is a support. However, the 20-day moving average, which is a support on the Nifty, has turned out to be a resistance on the Nifty Bank, which is underperforming right now and broke below the 20-day moving average on Friday itself. So that's the level that we are watching out for on the Nifty Bank. How does that compare with the technicals and the charts? We do have Ruchit Jain with us. Ruchit, your thoughts?
Yeah, hi, very good afternoon, Mangalam. Well, I think if you look at during last week, we witnessed a move in Nifty from 17,700 towards that 18,100 mark. And that was primarily because of the short covering from FIS front, where their long short ratio at the start of last week was around 16 or 17%. From that, it came towards the 27% mark. So clearly, some of the short positions were covered, which led to that up move in the Nifty. But technically now that up move has led to a breakout from a falling channel. And the support end of that channel is now coming around in that 17,800 to 850 range. So if I look at technical analysis, then this could be just a pullback move to retest that breakout. Now if I come on to some of the options data, then in Friday's trading session we saw significant open interest addition in both 18,000 call option as well as 18,000 put 100. And even if you see now, the open interest that was created on Friday is still intact, and the combined premium on Friday in both those options when the open interest built up was seen was around 200 points. So assuming that option writers are have taken positions and both these options by setting a straddle, then it means that they are not expecting the market to go below 17,800 in this expiry, neither above 18,200. So options data is indicating that we would continue to consolidate within this range, where 17,800 would act as a support. So any declines towards that 17,800, 840, I think those ideally would be good levels to go long on the Nifty. But yes, we are avoiding any trades in the Bank Nifty as of now because of its underperformance, and rather looking to play with more of a stock-specific strategy.
In fact, I wanted your thoughts on some stocks. Cement stocks are hitting fresh 52-week highs today. Shree Cement, Ultratech Cement, all at fresh 52-week highs. There's also something like a Persistent Systems, which is at a fresh 52-week high. So any thoughts here? Do you see more upsides in these names?
See, quite possible. We have to identify those sectors or those stocks which have been showing a good price volume action even in this consolidation phase. So I think that outperformance would continue. Initially, we saw with some capital goods sector at the start of this series, where many of the capital goods stocks witnessed a good momentum, and that outperformance has still continued. I think similarly, the IT definitely has shown a good outperformance, and that I think outperformance could spread to some of the mid-cap IT names now. The large-cap IT names have already moved. So now some of the mid-cap IT names could see some good outperformance in next few trading sessions. And of course, the cement sector stocks, and especially the large stocks such as Ultratech or Shree Cements, have witnessed a good breakout from the previous swing highs as well. So as I said, those sectors or those stocks which are outperforming in this consolidation, I think that outperformance could continue. So one needs to identify such names.
All right, Ruchit, thanks a lot for joining in and giving us those picks. Meanwhile, just keep an eye out on some of these alcohol stocks. United Breweries already was under a wee bit of pressure from the start of today's trading session, primarily on account of the resignation of its MD. But now the Madhya Pradesh Chief Minister has tweeted that there will be no new liquor shops which will be opened in the state. At the same time, liquor shops, there won't be any liquor shops around in a 100-meter radius against 100-meter radius around educational institutions, and it's a policy to discourage drinking. It's a mild negative, not too much, because Madhya Pradesh, there won't be no new liquor shops which will open. So whoever has to buy,
negative, right?
Whoever has to buy, they will buy from the existing shops itself. The big negative would have been had they shut those shops itself. And around educational institutions, we'll have to figure, how much is the contribution.
100 meters.
100 meters is, but it is in a city, the radius could be a lot more, the density, etc. We'll need to know some more details on that. But from a state density standpoint, Madhya Pradesh isn't among the top 3 or top 4 consumers of liquor in the country anyway. So let's see how that goes. It is a mild negative, no more.
Okay, let's see. United Spirits, United Breweries in focus. Not much of a reaction on the back of this particular piece of news as of now. Like Mangalam mentioned, it could probably be a limited reaction that we could see. Need to take a short break, but on the other side, Prashant Mehra, partner at Grant Thornton, Bharat LLP, will join in for a discussion on the deal trends in January 2023.
Welcome back. Let's concentrate on the deal street and the deal tracker segment for the day. And Grant Thornton Bharat's Prashant Mehra is joining us with exclusive details on the findings of the report for the month of January. Prashant, always a pleasure to welcome you on CNBC TV18. My first question, well, the value of deals has really substantially dropped in the month of January, not just compared to December, which could be a year-end transactions ending, but even compared on a YOY basis to January last year. What are the few important reasons for this, and are macroeconomic factors really hurting the deal street already?
Hi, thank you for having me back. You're right. I think not just the values, but even the volume has declined, and that's something that was kind of expected. I'm not too sure if comparing it to either December, as you rightly mentioned, or for that matter, even January of 2022 is an apple-to-apple comparison, because January of 2022, we were still coming out of the pandemic, and it could be a lag effect of the pandemic. Having said that, what the encouraging factors are that there are some deals in new sectors, the infrastructure sector especially. One reason why the values are also low is because in this period, we haven't seen really any big ticket transactions as we saw in the same period last year. Now that the budget is out, we're hoping, and it's a very forward-looking budget with special thrust on infrastructure, which is a continuing flavor for the government, and having seen energy and natural resource transactions already being demonstrated in January, the next few months are hopeful. I think the tide would turn somewhere in April.
All right, tide would turn somewhere in April. Can you highlight more on the specifics from the budget, which is positively impacting the infrastructure deals? And energy and renewable energy anyways has been the flavor of the season for last 1.5 years. So what else in infrastructure is seeing an uptick, and what are we here to see in the next few months in terms of transactions and even fund play?
I think a couple of things. One, the government's continued investments into the infrastructure sector demonstrates that this is here to stay. Any investment in the infrastructure sector has both a socio-economic impact because it not only creates employment, but also improves supply chain logistics. In turn, it gives incentives to other players, whether it's the FMCG sector or anything, or the infrastructure sector also, to invest more and play with the growing demand. Given the tepid environment outside of the country, especially in the West, we would see a lot of foreign fund play here as well, both in direct infrastructure as well as allied industries such as energy and manufacturing.
Right.
And I think all that will unravel in the next couple of months,
right.
which is why from April onwards, we could probably see some deals coming through.
All right, and Prashant, we can just hope that REIT InvIT change in taxation, which is still under discussion with the ministry, is not really putting a dampener on the infrastructure deals that you're talking about. But what about the private equity players? They have done bulk of the transaction done in Jan. The larger amount has really come in only from the private equity space through some bulky transactions. Now, how are they poised? And with the valuations really dropping at this point, are they on a wait and watch mode? What are you gathering from the private equity fund spending as well as acquisition and buyouts?
I think private equity, if you look at the volumes, it's not really declined as much. But as you rightly mentioned, the value is declining, and that's because of a valuation correction. We were expecting that to happen, and will probably happen a bit more. I think where the large private equity transactions will be seen is in terms of domestic funding, domestic consolidation, since acquisition financing is still not allowed in the country by the bank. So private equity will be looked at as an alternate means of investment, and whether it's the manufacturing sector or the larger FMCG sector, the logistics sector, the larger infrastructure and technology sector, we will see a lot of private activity there. And I would say that a lot of dollars of private equity will probably be focused towards that.
All right. Well, very important point made by you, Prashant. And biggest takeaway is that private equity is going to really participate in acquisition funding. But we are hoping that IFSC, giving that thrust to the banks to finance acquisitions, will in some years will play a big role in this particular space as well. Always a pleasure speaking to you. Thank you so much for joining us. So that's a wrap on Deal Tracker for today. But after a short break, come back for more news and updates and market action.
Well, on to our special segment, Value Add, where we talk about stocks that are in focus. I am looking at Lumax Auto. Now, it's a smaller auto ancillary company, but it's up almost 9% right now after making an acquisition. They've acquired 75% stake in an Indian company called IAC Automotive India. Now, the equity value of this is a little under 600 crores, which implies an EV to EBITDA multiple of 6.1 times as per the calendar year 2022. But this company, just let me tell you a little bit about the acquisition. It's a tier 1 interior systems and component supplier. So basically, it supplies to key automotive OEMs like Mahindra & Mahindra, Maruti Suzuki, Volkswagen, Volvo Eicher, and very strong financials. IAC has seen a revenue growth of 70% year on year for FY22 to 481 crores. Post the acquisition, IAC will continue to be a 25% shareholder. Now, if you look at the revenues of IAC, the acquired company, over the last 4 years, it's gone up. In the 9 months of this year, it's about 470 odd crores. But in the last 3 annual years, it's gone up from around 280 crores all the way to 481 crores. And the rationale for an investment for Lumax Auto, one would be EPS accretive. It's also the interior and lighting business is very strong, so that will help Lumax Auto. There are long-term partnerships with global leaders in plastic interiors and exteriors. This will be an addition of a significant business in the passenger vehicle and the SUV segment. And this will, of course, lead to an expansion in the product portfolio in the plastic segment for Lumax Auto. So that's a good acquisition that Lumax has made, and the street definitely likes it, up almost about 10% odd. We'll step into a quick break. On the other side, Manisha Gupta will join in. She has with her Peter Maguire of XM Australia. Stay tuned.
Welcome back. Joining us on the show now is Peter McGuire from XM Australia. Peter, hi, good to have you. It's the crude oil prices that we are looking at right now, and we've seen 2 weeks of constant declines onto this one. Last week actually was 5% of a cut coming in. At $83 a barrel, what would you want to look at? Because the Russian oil continues to come into the markets. We are looking at higher inventories in US. US also is looking to sell some more, or rather give out more crude from SPR as well. So supply as a concern really seems to be going away.
Absolutely. And good afternoon, Manisha. Look, it's been a dynamic couple of weeks, and we've got to put our mind across. Also, you've seen a big run up as far as US dollar index, and that's taken the heat out of a lot of the markets as far as commodities. But you can't get your eye away from the situation as far as the China with Russia and the talks going on there. Think about what happened geopolitically with Blinken, and also appreciate that we could be in, I think, some hot water coming forward. So I've just got to sit here and look at the markets. Some of them have been tailed off very heavily over the last couple of weeks, some of those base metals, and they've also dragged down energy. So it's a time to be short, but maybe that's going to reverse, Manisha.
So when you do talk about being short, what are you really looking at? Because yes, the markets also are looking at the dollar holding at 103 or 4 kind of levels. Higher US Fed rate hikes is another thing, and the Chinese demand, a big question mark on the sustainability of it. What is it that's more bothering for you on the demand side of it?
Well, I'm looking from, first off, the demand side. I want to see what goes on as far as Jay Powell's comments this week, where we're thinking as far as how many more rate rises over the next matter of months, and what's the headline going to be. So that really, I don't think is that we've got a line in the sand definitively drawn in there. So we sit here and just wait and trade, intraday or over a couple of days. But I feel as though that I'm looking at the big themes. I want to see what happens as far as global central banks and what the rhetoric is moving forward for the rest of the month, Manisha, unless we see something dramatic happen geopolitically.
Oh, yes. So, even if we are keeping on the short side here, how much of further decline are you anticipating, Peter? Starting with energy first, for the crude oil prices, where do you see supports now kicking in?
Well, I think we've washed out pretty hard. I mean, maybe you might see another $1 or $2, Manisha, but it's very choppy. you're seeing big moves over. I mean, Friday night was massive. We were nearly down 3%. So, hang on to your hat because it's volatile. And over a session, you can see, quite a lot of whipsawing. So maybe another dollar or two wiped out, but I won't be surprised to see a reversal, Manisha.
So what range are you looking at, Peter? If $2 of a decline, what kind of an upside are we looking at?
Well, yeah, I think you're going to give back some of that stuff that you took out on Friday. So we got no trade today on President's Day. But overall, I think you might be up for a bit of an uplift this week, maybe up a couple of bucks, Venetia. So until we get some definitive news as far as what's going on or what are the key drivers, it's just, trade the day and just see how you go performance-wise.
Before we let you go, Peter, how are you looking at the metal space? I mean, you mentioned that there is decline as well. The last couple of weeks have been quite on the lower side here. Are there any buying opportunities now emerging?
Well, I just, looking at the numbers, Manisha, we got 20% down for 10 in 3 weeks. That's a wipeout. You've got aluminium down 10%. You've got copper down 4%. Now, I think that they're probably at those bottoms. We've had China reopen and they've given up all of that hot air. So maybe it's a time now we're going to see again a reversal to the upside. It's cheaper now than it was 3 weeks ago. So it's a good time to be trading these particular metals.
Okay, all right, Manisha, as well as Peter, thank you very much for joining in and taking us through that conversation on the entire commodity space. For the markets, it's definitely trending lower. For the Nifty, it's down around 50-odd points, not being able to sustain those 18,000 levels. The Bank Nifty also underperforming quite significantly, down around 0.5% for the Bank Nifty. It's a wrap on Halftime Report. Business Lunch up next. Stay tuned.